Three things just happened in the last 24 hours that confirm the market is lying to you. And a fourth thing happened that the financial media is pretending doesn't exist. You're watching a slow-motion regime change in real time. Paper silver losing power, physical silver taking it back. You can feel it in the charts, but you can prove it in the receipts. You're watching hidden power archives. Let's break it down. Here's what happened, clean and simple. A US-led policy framework is being discussed with allies that effectively creates a protective floor under critical minerals pricing. A major North American silver producer reported that it sold silver at a realized price dramatically above the benchmark, nearly a third higher in the same quarter. The biggest online dealer in the US says shipping delays have finally cleared after weeks of stress that exposed how fragile the retail pipeline really is. And a large block of in-the-money call options is sitting near a delivery pressure point that banks normally crush long before it becomes a headline. 4 angles, 1 conclusion. The spot price you see is starting to look less like a price and more like a suggestion. And when price becomes a suggestion, the only thing that matters is who can deliver metal. Let's start with the policy move, because this is the one that changes the rules of the game. Most people hear critical minerals and think lithium, rare earths, maybe copper. They don't think silver. They treat silver like an old-world metal, a legacy commodity, a shiny relic. That's the mistake. Silver is not just jewelry and coins. Silver is the electrical bloodstream of the modern economy. It sits inside solar manufacturing, electronics, defense systems, high-end industrial tooling, and anything that needs the highest conductivity at scale. Now picture this. Governments are looking at the market and realizing a brutal truth. The price mechanism is broken. Not volatile, not unfair, broken. Because when you have a supply chain dominated by strategic rivals, the free market becomes a weapon. You can dump product, you can subsidize refining, you can undercut competitors, you can starve investment in mines and processing, and then you control the future. That's what policymakers are staring at, and the response is simple, even if it sounds insane at first. They want a reference price system across critical minerals, a framework that acts like a backstop, a floor, a minimum threshold that protects domestic and allied supply chains from being crushed by distorted pricing. Let that sink in. A floor isn't a forecast. It's a signal of intent. It's a government admitting that a strategic resource cannot be left entirely to a paper market that can be smashed in a single session. It's not free market economics. It's economic warfare with spreadsheets. And if silver is included in the strategic umbrella, directly or indirectly through reserves and security policy, the implication is monstrous, because a floor changes behavior. Miners don't invest when the downside is unlimited and the price can be slammed below costs by paper leverage. They invest when there's a backstop. Industrial buyers don't wait when they believe supply is strategic and policy is turning. They pre-buy. They secure. They sign long contracts. Investors don't treat it like a gambling chip when the market tells them policymakers are building a safety net under the commodity. They treat it like a strategic asset. A floor doesn't guarantee higher prices tomorrow, but it changes the long-term direction of capital. And capital is what determines whether new mines get built, whether refining expands, whether inventories replenish, and whether the market can survive the next demand spike. Here's the part the mainstream misses. A floor is also an admission that the current price is too low to sustain the supply chain. That's the quiet message, not shouted, not advertised, but baked into the logic. Because nobody builds a backstop under something they believe is fairly priced. You build the backstop when you think the price is being distorted downward. Now connect that to what you've just lived through. A historic crash, a massive drawdown, a narrative blitz telling you the move is over, telling you the bubble popped, telling you the market has spoken. And then, policymakers show up talking about protecting critical mineral pricing integrity. Do you see the contradiction? The narrative says, silver got exposed. Policy says, silver is too important to be left to this. That's not normal. That's the tell. And it gets worse for the paper crowd when you look at the miner report. Because policy talk is one thing, numbers are another. You can argue with speeches. You can't argue with audited realized prices. A major producer reported a quarter where the benchmark average price was one number, and their realized price was dramatically higher. Not a couple percent, not a small variance. A premium so large you have to ask the obvious question. How does a producer sell above the benchmark in a world where everyone claims the benchmark is the truth? There are only a few ways it happens. 1. Timing. If a company sells more into spikes, their realized price can beat the quarter average. Possible, but not enough to explain a massive premium unless the timing was unusually perfect. 2. Product mix. Some sales are refined, some are concentrate, some are structured contracts. Possible. But again, when you see a premium that large, you're forced to look at the bigger mechanism. 3. Direct demand. Industrial and institutional buyers bypassing the paper exchange and buying supply closer to the source, paying up, because they don't want exposure to the maybe of delivery. They want certainty. They want metal. Now here's the real message buried inside that premium. If a producer can consistently realize prices far above the benchmark, then the benchmark is no longer the center of gravity. It's becoming a reference point for paper trading, not for physical procurement. And once physical procurement detaches from paper, the paper price becomes fragile. Because what supports a paper price is belief. Belief that paper can be converted to metal. Belief that the exchange represents reality. Belief that the spread between paper and physical will stay manageable. But premiums like that are a crack in the dam. They're the market whispering, "We'll pay extra to avoid the casino." And if buyers are willing to pay extra to avoid the casino, it means the casino is starting to run out of chips. Now let's talk about the dealer story, because this one hits retail psychology hard. A major dealer tells customers, shipping is back to normal, customer service is back to normal, fulfillment is back to normal. And people hear that and think, okay, the shortage is over. That's exactly the conclusion the system wants you to jump to, because it confuses logistics relief with structural supply relief. They are not the same thing. A dealer clearing delays can happen for multiple reasons. Yes, supply can improve. Yes, staffing can improve. Yes, back-end operations can catch up. But there's another reason delays suddenly disappear. Demand temporarily collapses after a violent price smash. That's how these cycles work. You get the run. You get the panic buying. You get the bottlenecks. Then you get a savage drop that scares people into waiting. The dealer breathes again. Operations normalize. And everyone declares, see? It was nothing. Then price recovers, demand returns, the pipeline breaks again, and the people who waited learn the hard way that normal shipping can vanish overnight. So the real question isn't, are they shipping today? The real question is, what happens to shipping the moment the next wave of buying hits? Because the next wave is never polite. It's never orderly. It's emotional. It hits on weekends. It hits after headlines. It hits when the chart confirms a reversal and the crowd realizes they hesitated at the bottom. That's when inventories vanish and lead times explode. The dealer letter is not proof the story ended. It's proof the system was stressed enough that the largest player had to publicly address it. That alone is the signal. Big operators don't write public comfort letters in calm markets. They do it when the market is so violent that trust becomes a business risk. And if trust became a business risk once, it can become one again, fast. Now we hit the fourth signal, the one banks hate the most, the one that turns paper games into metal problems. Options. Call options sitting in the money near first notice. That phrase sounds technical, but the concept is simple. There is a window where paper contracts can become a demand for physical settlement. Most of the time that window is managed. The system leans on price action. It leans on volatility. It leans on fear. It tries to knock those calls out of the money before expiration, so fewer people have the incentive to convert paper into something the vault has to deliver. That's why you often see mysterious price pressure around key dates. It's not a conspiracy theory, it's incentives. If you are short and you can push price down at the right moment, you reduce exercised calls, you reduce delivery risk, you reduce your headache. But here's the problem. Even after an extreme crash, a large cluster of calls is still sitting in the money, meaning the smash didn't finish the job, meaning the attempt to reset the board didn't erase the pressure, meaning the market snapped back hard enough that the option structure is still a threat, and this is where the math becomes uncomfortable. Each futures contract represents a fixed amount of metal. So if even a fraction of those in-the-money calls become exercised futures positions, and if even a fraction of those exercised positions decide to stand for delivery, you can get a delivery request that is large relative to registered inventory. Now, do all options turn into delivery? No. Most traders close for cash. Most players never want bars, they want profit. But the world changes when the physical market is tight. Because tight physical markets create arbitrage, and arbitrage changes behavior. If physical sells at a premium, then converting paper into deliverable metal can become a business model. If you can acquire metal at one price and sell it into a tight market at another price, the paper-to-physical pathway becomes valuable. And once that pathway becomes valuable, the exchange faces a question it never wants asked publicly. Can you deliver when enough people decide they want the thing the contract represents? That's the nightmare. Not because the exchange collapses tomorrow, but because the risk premium begins to creep into everything. Lease rates, spreads, premiums, confidence. And when confidence fades, the demand for real increases. People stop asking, "What spot?" They start asking, "Can you get it?" Now step back. Look at the four signals together. Policy backstop talk. A producer realizing premium pricing. A dealer pipeline that recently seized up. And an option structure sitting near a delivery pressure point. Different corners of the market, all pointing in one direction. The paper market is losing the monopoly on price discovery. Because price discovery only works when the quoted price reflects the cost to obtain real supply. If the quoted price is one number and the real-world procurement price is another, then the quote becomes less meaningful. And when that happens, the market doesn't politely adjust. It breaks in episodes. Volatility, short squeezes, premium explosions, then calm, then another break. That's how commodity regime shifts happen. Not in one clean day, but in a series of fractures. Now let's talk about psychology, because this is where retention is won or lost. The system doesn't defeat you with math. It defeats you with emotion. It wants you exhausted. It wants you motion sick. It wants you checking the chart every 5 minutes until you can't stand it. Because when you're tired, you make stupid decisions. You sell bottoms. You chase tops. You freeze at the worst moment. That's the game. So here's the simplest way to think about what's happening. Paper tries to control perception. Physical controls reality. Paper can smash price in a session. Physical can refuse to show up at that price. And when physical refuses, paper becomes a story that can't be delivered. That's why premiums exist. Premiums are the market's way of confessing the quote is not enough. Premiums are reality tax. And the moment you see miners realize a huge premium, you're watching that reality tax migrate upstream. From retail, to wholesale, to producers. That's not small. That's the chain tightening. Now here's the cliffhanger that matters. If a government-backed floor framework actually becomes real policy across a block of allied nations, what happens to downside volatility? What happens to the old playbook of smashing price below costs to shake out weak hands? What happens to the incentive structure of shorts when they know policy is being designed to prevent catastrophic undervaluation of strategic inputs? You don't have to love the idea. You don't have to trust it. You just have to understand what it does to the game. It tells miners, keep building. It tells industry, lock supply. It tells investors, this is strategic. And it tells paper sellers, the political climate is shifting against you. Now I want to bring you to the center of the storm. If the market is snapping back, if the option structure is still alive, if physical premiums remain stubborn, if producers are reporting above benchmark realized prices, then the question isn't whether volatility returns. The question is how violent the next repricing episode becomes. Because the last smash was an attempt to reset positioning, and the fact that the market recovered enough to keep a large block of calls in the money tells you the rebound is not a dead cat bounce. It looks like a market trying to return to a price where supply and demand can breathe. And if policy steps in and implies there's a line in the sand, the market will test it. Hard. Markets always test lines. Now let's talk about what this means for the next move. Not predictions, scenarios. Because smart analysis is not about pretending you know the future. It's about identifying the levers. Here are your levers. 1. Policy clarity. If more officials confirm the framework, markets will treat it like forward guidance. 2. Producer behavior. If more miners report premiums or sign direct deals, it validates that physical is paying up. 3. Dealer behavior. If retail demand returns and shipping delays reappear, it confirms the pipeline is still fragile. 4. Derivatives pressure. If open interest, call concentration, and delivery behavior tighten into first notice windows, the paper market gets forced to respect reality. Now here's where things get uncomfortable for the complacent crowd. Even if you believe the paper market survives, even if you believe they'll manage it, you still have to ask this: why are industrial buyers paying up? If paper is fine, why not just buy paper and take delivery? Why go direct? Why pay premium? Why lock contracts? The answer is always the same: certainty. And certainty is what tight markets destroy. Now I want to ask you something, and I want you to answer in the comments. If a strategic floor becomes real policy, do you think it creates a genuine long-term support level? Or do you think it backfires and causes even more volatility because it attracts more capital into a market with limited physical supply? Drop your take below. And here's the second question. If producers can realize huge premiums above benchmark, what do you think the real price is? Not the paper quote, the price where supply actually clears. What number do you think the market has to print before the physical pipeline stops choking? Put your number in the comments. I'll be reading them. Now let's address the skeptic argument before it hijacks the room. Some people will say, options don't matter, it's all cash settled. Some will say, premiums are just retail noise. Some will say, policy talk is political theater. Okay, maybe, but here's what you can't dismiss. When 4 independent signals point the same way, the probability of coincidence collapses. Policy backstop talk, producer realized premiums, dealer pipeline stress, options structure pressure. Those are not the same data set. Those are not the same audience. Those are not the same incentives. And yet they're all saying, physical is tight, and the world is starting to treat silver like a strategic input, not a hobby. Now I'm going to give you the cleanest mental model you can use. Paper sets the headline, physical sets the ending. Paper can print a story. Physical decides whether the story can be delivered. And right now, the story is being challenged. Not by Reddit, not by hype, by procurement departments, by producers, by policy, by the mechanics of delivery itself. That's why this setup is so dangerous for complacent shorts, because it's not one catalyst, it's a convergence, and convergence is what creates the biggest moves. Now, before we close, I want to give you the practical takeaway. Not advice, not a recommendation, a lens. Stop watching only the price. Watch the spreads, watch the premiums, watch the delivery behavior, watch producer realized pricing versus benchmark, watch policy statements about strategic minerals, because those are the signals that tell you whether the paper market still controls the narrative, or whether the physical market is rewriting it underneath. If you see more premiums upstream, it means physical tightness is spreading. If you see more policy clarity, it means the floor concept is moving from discussion to architecture. If you see more dealer stress, it means retail demand is returning faster than the supply chain can handle. If you see delivery pressure increase, it means the paper market is being forced to respect real constraints. And here's the final cliffhanger you need to sit with. If the market can survive a smash and still keep significant call interest in the money, if it can recover while physical premiums stay elevated, if policymakers are openly discussing backstops for strategic minerals, then what happens when the next rally leg forces the crowd to return? Because the crowd always returns late. That's what they do. They wait for confirmation. They wait for headlines. They wait until price is higher. And then they all rush the door at once. And that door is the physical pipeline. Now think like an engineer for a second, not a trader. If the system was strained when demand spiked the first time, what happens when it spikes again, but inventories are lower? What happens when producers know they can get paid above benchmark? What happens when industrial buyers decide they cannot risk being last in line? That's how squeezes happen. Not because people on the internet get excited, because the real-world buyers decide they need certainty more than they need the lowest price, and certainty costs premium. Now, if this breakdown helped you connect the dots, do one quick thing for me. Subscribe to Hidden Power Archives, short and simple, because this channel exists to map the hidden mechanics behind the obvious headlines. And if you want the next update the moment the next signal hits, you'll want it in your feed before the narrative machine spins up again. One last time, 4 signals, 1 direction. Policy is building a floor. Producers are selling above benchmark. Dealers just admitted the pipeline snapped. Options pressure is sitting near a delivery window. Paper is trying to control perception. Physical is tightening reality. And reality always wins, eventually. Now drop your 2 answers in the comments. Does a price floor create stability, or does it ignite volatility? And what do you think the real clearing price is when physical demand is the one writing the rules? We'll see who reads the market. and who reads the headlines.